It was 1986, and Margaret Thatcher was rewriting the rules. The sale of British gas was the crown jewel of the privatization experiment. The promise was seductive and simple. It was a revolution in how we lived. We would stop being a nation of workers and become a nation of owners. Shareholder democracy was the buzzword of the decade. They sold it to us on billboards and TV. If you see Sid, tell him he can own a piece of the pie. They told us state industries were sluggish and inefficient. They said they were draining the public purse and holding back the British economy. The solution was the free market. Privatization would unleash competition. It would drive down prices. It would make us all rich in the process. But they didn't tell Sid the whole story. They didn't tell him what would happen after the initial sugar rush of the share price pop faded away. They didn't tell him that 30 years later, the assets wouldn't belong to him. They wouldn't even belong to British pension funds or insurers. They would be carved up and sold off. They would be stripped down to the copper wiring. They would be loaded with debt to pay foreign investors. This isn't just a story about bad management. This is a story about the systematic dismantling of the UK business economy over 4 decades. We are going to look at the crime scene. We are going to follow the money. And you will see that the money leaves Britain and never comes back. Let's start with the basics of ownership. What does it actually mean to own a British company today in a market that is slowly dying on its feet? Take a look at the London Stock Exchange. It used to be the engine room of the empire. It was the financial center of the world for centuries. Today, it is shrinking before our eyes. It is a shadow of its former self. Companies are fleeing the city of London like it is a sinking ship. The headline-grabbing story is Just Eat. You know them well. You probably have the Orange app on your phone right now for your Friday takeaway. Just Eat was a British tech success story, founded in London, grown in the UK, a member of the FTSE 100 index. It was the future of our economy. But in 2020, they merged. They joined forces with Takeaway.com, a Dutch company that saw the value in our market share and grabbed it. Suddenly, the center of gravity shifted. The headquarters wasn't really here anymore. The strategic brain moved to Amsterdam across the channel. And then came the hammer blow, the announcement that they were delisting from the London Stock Exchange to focus on their Dutch listing. Why did they leave us? They said it was about complexity. They said it was about costs. They said the administrative burden was just too high. But read between the lines of the press release, it was about value. They didn't think London investors understood what they were truly worth. They looked at the trading volumes in London, they looked at the liquidity, and they saw a graveyard where tech companies go to stagnate. So they packed their bags, a British tech giant delisting from the British market, taking their capital and their growth potential with them. And they aren't the only ones leaving. This is a pattern. This is an exodus. It is a slow-motion bank run on the credibility of UK PLC. Look at Arm Holdings. This is the most important technology company Britain has ever produced. The jewel in the crown of Cambridge Silicon. Their chip designs are in your iPhone right now. They are in your car's engine management. They are in 70% of the world's electronics. It was a miracle of British engineering. A company conquering the global silicon market from a science park in the east of England. But in 2016, right after the Brexit vote, it was sold. SoftBank, a Japanese conglomerate, bought it for £24 billion. The government cheered the deal. They said it showed Britain was open for business. That phrase is always used when selling the family silver. But what happened next was predictable. SoftBank took it private. They delisted it from London. The transparency of the public market vanished. And when they decided to list it again in 2023, did they bring it home? Did they return it to the London Stock Exchange? No, they listed it on the Nasdaq in New York. The British Prime Minister lobbied them personally. The Chancellor begged them to come back. They rolled out the red carpet in Downing Street. But SoftBank looked at the numbers. They looked at the valuations in New York versus London, and they chose New York. The valuation gap was undeniable. US markets pay a premium for tech. London markets pay a discount for everything. Arm Holdings is now a US-listed company. The headquarters might still be in Cambridge, but the capital flows to Wall Street and Tokyo. This is the branch office syndrome. Britain gets the jobs. Maybe. For a while. But we don't own the IP. We don't own the profits. And it is not just tech. It is the old guard too. The industrial giants that built the infrastructure of the 20th century are leaving. Look at CRH, the building materials giant, one of the biggest companies in the FTSE 100. They make the concrete that builds our cities. They manufacture the asphalt for our roads. They are as physical as it gets. A real economy business making real things for real people. In 2023, they packed up. They moved their primary listing to New York. They said 75% of earnings were American. They said the US market would value them higher. And they were right. The moment they moved, their valuation jumped. The market rewarded them. Ferguson did the same thing. The plumbing giant. You might know them as Wolseley. They looked at the London market and saw stagnation. They looked at the US market and saw growth. So they left. They delisted. They are an American company now in everything but their history. This destroys the ecosystem. When the big companies leave, the index shrinks. When the index shrinks, passive funds sell their holdings. It creates a doom loop, a spiral of decline. Less liquidity leads to lower valuations. Lower valuations lead to more delistings. And who is buying what is left? This is where it gets dark. This is where we talk about private equity and the asset strippers. The UK market is currently trading at a massive discount. British companies are cheap. They are trading at a 40% discount to peers. This isn't a buy signal for British investors. It's a dinner bell for foreign raiders. It is a going out of business sale for the nation. Let's talk about the supermarkets, the places where you spend your money every week, the bedrock of the British high street and community. Chas Morrison's, a Bradford institution. Sir Ken Morrison built it from a market stall. He was a grocer who knew the value of a penny. It was a prudent company. It owned its own stores. It owned its own supply chain. It even owned its own abattoirs and food processing plants. Sir Ken didn't like debt. He liked assets. He liked control. He knew that if you own the building, nobody can raise the rent on you. But Sir Ken is gone. And in 2021, the sharks began to circle. They smelled the asset value, and they saw the low share price. Private equity firm Clayton, Dubilier, and Rice. CD&R, an American outfit with deep pockets and a ruthless playbook for extraction. They bought Morrison's for £7 billion. But they didn't just write a check from their own bank account to buy the business. They used a leveraged buyout. This is the financial weapon of mass destruction that has destroyed the integrity of the British high street. They borrowed the money to buy the company, and then they transferred that debt onto the company's own balance sheet. It is a magic trick. Think about that. You buy a house, but you make the house pay the mortgage. You take the risk, but the asset bears the burden. Before the takeover, Morrison's had debt of around £3 billion. It was manageable. It was a normal part of doing business. After the takeover, the debt obligations ballooned to £7.5 billion. The interest payments alone became crippling. Suddenly, Morrison's wasn't working for its customers. It wasn't working for its staff. It was working to service the debt mountain. It was working for the bondholders. And how do you pay off that debt when margins in the supermarket business are razor thin? You strip the assets. You sell the furniture. Morrison's owned 87% of its store's freehold. That was its superpower. But to private equity, that isn't strength. That is lazy capital. That is an asset to be liquidated for a quick cash injection. So they started selling the warehouses. They started selling the petrol stations. They engaged in sale and leaseback transactions. They sold the buildings for cash, then rented them back. It generates a quick hit of cash to pay down the debt they created. But now, the supermarket has a rent bill, forever, a permanent increase in fixed costs, just to pay for its own purchase by a foreign firm. And the result? In 2022, Morrison's posted a loss of £1.5 billion. The finances were decimated. They lost their spot as the UK's fourth biggest supermarket. Aldi overtook them. They couldn't compete on price with the discounters. How could they compete? They had to pay the interest on the debt. Every pound of profit went to the banks, not to lowering prices. They cut staff. They cut investment. The stores got shabbier. The prices got higher. The customer experience fell off a cliff. This is the private equity playbook. It is not about building business. It is about extraction of value from the existing carcass. And they did the same thing to Asda, the third largest supermarket in the country. Another northern powerhouse sold down the river. Asda was bought by the Issa brothers and TDR Capital, another leveraged buyout funded by debt and high-yield junk bonds. The deal was valued at nearly £7 billion, and they loaded the company with debt to make the numbers work for themselves. Asda's finance costs skyrocketed. In 2023, their interest payments rose by 38% to £600 million. £600 million, just on interest. That is money that isn't lowering the price of bread or milk for struggling families. That is money that isn't hiring more checkout staff. That is money leaving the business to pay global lenders and hedge funds. And now look at the petrol stations. The Issa brothers sold Asda's forecourts to their own empire, EG Group. Then they sold them back. It is a carousel of assets and debt, a financial engineering circus designed to move money around while the core business suffers. And while the company struggles, the owners pay themselves. In 2024, despite what they called an embarrassing performance, they approved a £44 million payout to the partners. They're extracting cash while the business burns around them. And who is letting this happen? The regulators? The government? They are asleep at the wheel. They are watching the fire and toasting marshmallows. But supermarkets are just one sector. The rot goes much deeper. It goes into the infrastructure of life itself. It goes to the water we drink. Let's talk about water. The most basic human necessity. You cannot live without it. It is a natural monopoly given to private companies. England is the only country in the world to have fully privatized its water and sewage system. Everyone else looked at us and said no thanks. Thames Water, the giant. It serves London and the Thames Valley. 15 million people rely on it every single day for survival. Before privatization in 1989, it had zero debt. Zero. It was a public service run for the public good. Then came the sale. And then came Macquarie, the Australian bank known as the Millionaire's Factory because of how much they pay their staff. They bought Thames Water in 2006, and they turned it into a complex financial vehicle designed to extract cash. During their ownership, they didn't build a single new reservoir. Not one, despite the growing population of London and the southeast. But they did borrow money, lots of it. They borrowed against the value of the assets. They leveraged the pipes and the sewage works. And what did they do with the borrowed money? Did they fix the leaks? Did they stop the sewage dumping into our rivers? No, they paid dividends. Between 2006 and 2017, Macquarie and its partners took out billions. They took out nearly £3 billion in dividends. Dividends paid with borrowed money. They paid themselves with credit cards. They increased the debt from £6 billion to £11 billion. They doubled the debt while stripping out the cash. They left the company drowning in liabilities. And they walked away with a profit. They sold it on to the next set of unsuspecting buyers. The Guardian called it the vampire kangaroo model. They sucked the blood out of the company and hopped away to the next target. And what is the legacy? Today, Thames Water has £14 billion of debt. They are technically insolvent without support. They are on the brink of collapse. They are begging the regulator to let them hike bills by 40% to pay for the mess. They are dumping raw sewage into the River Thames, billions of litres of it, because they didn't invest in the treatment plants. They spent the money on shareholders. And who are the shareholders now? Who actually owns the water in your tap? It isn't Sid. Sid sold his shares years ago. It is a consortium of foreign pension funds and sovereign wealth funds. OMERS, a Canadian pension fund for municipal employees in Ontario. The university's superannuation scheme. China Investment Corporation. That is the Chinese sovereign wealth fund. The Chinese state owns a chunk of London's water supply. Infinity Investments. That is a subsidiary of the Abu Dhabi Investment Authority. Oil money from the Gulf owns the pipes under London. Foreign governments own our water. When you pay your water bill, you are contributing to the sovereign wealth of China and Abu Dhabi. You are paying for the pensions of Canadian teachers. But you are not paying for clean rivers in England. The money leaks out. The system is rigged. The profits are privatized. The risks are socialized. And when the debt becomes too much, who pays? You do. The taxpayer. The government is already preparing contingency plans for nationalization. They call it special administration. That is the code word for a bailout. We sell it cheap. They strip the assets, they take the dividends, and we buy it back broken. It is the perfect crime. And it is not just water. Look at the energy grid. Who owns the wires that bring electricity to your house? If you live in London, the southeast, or the east of England, your distributor is UK Power Networks. Who owns them? It is owned by CK Infrastructure Holdings. That is a company based in Hong Kong. It is part of the business empire of Li Ka-shing. He is one of the richest men in Asia. He owns the cables under your street. He controls the power supply to the capital city. If you live in the West Midlands or the Southwest, you are paying Western Power Distribution. That was owned by PPL Corporation. PPL is an American utility company. They extracted profits from UK energy bills and sent them back to Pennsylvania. Then they sold it to National Grid. At least that is British, right? But National Grid is a multinational that makes huge profits in the US. And look at the suppliers, the companies that send you the bill. EDF. You see their blue vans everywhere. They run the nuclear power stations. They are building Hinkley Point C, the most expensive power station on Earth. Who is EDF? Électricité de France. And who owns Électricité de France? The French state. It is 100% owned by France. So when your energy bill goes up, you are directly subsidizing the French budget. The French government caps energy prices for French citizens. They keep bills low in Paris. How do they afford that? Partly by the profits they make in the UK market where caps are higher. British households are subsidizing French households. It is a massive transfer of wealth across the English Channel. We have sold our energy security to a foreign government, a government that can threaten to cut off the power when we have a dispute. Remember the fishing rights dispute in Jersey? The French government threatened to cut the undersea cables. They threatened the lights, and they could do it because they own the switch. We gave them the switch in exchange for a short-term cash payment. And it's not just the French, it's the Spanish too. Scottish Power. It sounds Scottish. It has the flag in the logo. It is owned by Iberdrola, a Spanish multinational utility giant. The profits go to Bilbao, not Glasgow, not Edinburgh. We have handed over the keys to our critical infrastructure. We are tenants in our own land, paying rent to foreign landlords. Let's talk about transport. The railways. Privatization was supposed to create competition on the tracks to lower fares. But you can't have competition on a railway line. You can't have two trains running on the same track at the same time racing. It is a natural monopoly. So they created franchises. They carved up the map and auctioned off the rights to run the lines. And who won the contracts? Arriva, owned by Deutsche Bahn, the German state railway. They ran trains all over the north. Keolis, majority owned by SNCF, the French state railway. They run huge chunks of the commuter network around London. Trenitalia, the Italian state railway. They run the C2C line and others. Abellio, the Dutch state railway. For years, the British rail network was a playground for European state-owned companies to make easy money. They ran our trains, they made profits, and they sent those profits home to improve their own railways in Germany and France. If you took a train from Manchester to London, you were helping to fund a high-speed line in Bavaria. You were subsidizing a commuter line in Utrecht. It is the ultimate irony of the privatization dogma. We were told the state shouldn't run railways because the state is inefficient, so we let other people's states run them instead. And when they failed, when the service got so bad the government had to step in, they handed the keys back, but only after extracting years of management fees. Now the government is creating Great British Railways. They are slowly renationalizing by stealth, but the damage is done. The rolling stock is leased from banks. The profits have left the building. And look at the airports, the gateways to the nation. Heathrow Airport. Heathrow is the busiest airport in Europe. It is a strategic national asset. Who owns it? Ferrovial, a Spanish infrastructure giant. But they are selling their stake. And who is buying into our hub? The Saudi Public Investment Fund. And Ardian, a French private equity firm. The Qatar Investment Authority already owns 20%. So our national hub is controlled by Riyadh and Doha. Foreign sovereign wealth funds control our access to the world. Gatwick Airport. Who owns that? Vinci Airports, a French company. They own just over 50% of the equity. The other half is owned by Global Infrastructure Partners, which was recently acquired by BlackRock, the American colossus. We don't own the ground we fly from. We just pay the landing fees. We are customers in our own country. So why is this happening? Why is Britain for sale? Why doesn't British money stay in Britain to fund British companies? We have huge pension funds. We have a massive insurance industry. The City of London manages trillions of pounds of capital. But they don't invest in UK assets. In the year 2000, UK pension funds held over 50% of assets in UK shares. Today, that figure has collapsed. It is less than 4%. Think about that. Less than 4% of our pension money is in the UK. British workers save for their retirement, but their money is sent abroad. It goes to Wall Street. It goes to Tokyo. Why? It is a regulatory stitch-up. Rules like Solvency II, introduced by the EU, but gold-plated by UK regulators. These rules made it expensive for insurance companies to hold equities. They forced them into bonds. They forced them into safety. So they sold their shares in British companies. They dumped the stock market. And then there were the accounting standards. FRS 17. This forced companies to mark their pension deficits to market every single year. It created volatility on the balance sheet. It made pension funds risk-averse. They dumped volatile shares. They bought gilts. They de-risked their portfolios. And in doing so, they defunded the British economy. This created a vacuum, a capital strike. There were no domestic buyers, so the valuations fell. The price-to-earnings ratios dropped. British companies became cheap relative to the rest of the world. The Brexit discount made it worse. Global investors got spooked by the political instability and the uncertainty of trade. So British assets became dirt cheap. And when assets are cheap, vultures swoop. American private equity firms saw the opportunity. Sovereign wealth funds saw the value we couldn't see ourselves. They saw strong cash flows and monopolies. They saw loyal customers who had no choice but to pay. And they saw a government that wouldn't stop them. The UK has one of the most open economies in the world. We have a laissez-faire attitude to takeovers that borders on negligence. France protects its strategic industries. They have a list of protected sectors. You can't just buy Carrefour without a fight. The US protects its tech. You can't just buy a strategic chip maker if the government says no on security grounds. But Britain, we put a for sale sign on the White Cliffs of Dover. We allowed Cadbury to be sold to Kraft. Cadbury was an iconic British brand. Kraft promised to keep the factories open. They promised to keep the Somerdale plant. 1 week after the deal signed, they announced they were closing it. They moved production to Poland to cut costs. We allowed Pfizer to try and buy AstraZeneca. We nearly lost our entire pharmaceutical science base to a tax inversion deal. We rely on the kindness of strangers. Mark Carney said that. He was talking about our current account deficit. We import more than we export. We spend more than we earn. To balance the books, we have to sell assets. We are selling the furniture to pay the rent. Every year, we sell another chunk of the economy to foreign owners. It is a slow-motion liquidation of the nation. And the impact is not just financial. It is cultural. It is political. When a company is headquartered in London, the CEO lives here. The board meets here. They care about the local community. They sponsor the local football team. They fund the local arts. They are embedded in the fabric of the society they operate in. When the headquarters moves to Chicago or Dubai, London becomes just a branch office, a sales outpost. The high-value jobs go, the strategy jobs go, the legal jobs go. The research and development budget gets cut first. We become a service economy for foreign masters. We drive the Ubers. We deliver the Deliveroos. We serve the coffee. But we don't own the platforms. We don't own the algorithms. We don't own the brand. We are digital serfs. Look at the tech sector again. We are great at starting companies. We have world-class universities in Oxford and Cambridge. We have brilliant engineers. We create DeepMind, an incredible AI company. Google buys it and moves the IP to California. We create SwiftKey, a brilliant keyboard app. Microsoft buys it. We create autonomy. HP buys it, and it ends in a lawsuit. We create ARM. SoftBank buys it. We are an incubator for American and Asian capital. We do the hard work. They harvest the rewards. Because we don't have the patient capital to scale them up. Our pension funds are too timid. Our investors are too short-term. They want a quick exit. They want to sell out. Tell Sid he should have held on. But Sid didn't have a choice. The institution sold out from under him. And now, we are seeing the endgame. The delistings are accelerating. The London Stock Exchange is in crisis. The number of companies listed on the main market has fallen by huge numbers. New listings are drying up. Why would you list in London? To get a low valuation? To get no liquidity? To get press hostility? You go to New York. And as the market shrinks, the city of London loses its relevance. The ecosystem withers. We lose our status as a global financial Tier 1 city. We become a museum, a theme park for tourists. Come and see the changing of the guard. Come and see the empty shell of the London Stock Exchange, where we used to trade the world. So what is the future? Is it a completely foreign-owned economy? A rentier state, where we pay rent on everything? We pay rent on our water. We pay rent on our energy. We pay rent on our trains. We pay rent on our homes to offshore entities. We are already there. The dividends flow out. The debt stays here. When Thames Water collapses, the shareholders will be wiped out. But the debt, the £14 billion, that will be our problem. The mess, the sewage in the rivers, that is our problem. The broken pipes, that is our problem. Privatization privatized the profits, but the liabilities are ours. They always were. We need to wake up. We need to look at the pattern. From the sale of Royal Mail, which was undervalued and sold cheap, to the sale of the Green Investment Bank, sold to Macquarie, the same people who drained Thames Water of its cash. We sell our assets to the very people who have a track record of stripping them. Why do we do it? Is it ideology? Is it incompetence? Is it corruption? Or is it just desperation? The desperation of an economy that has stopped making things. It is hard to support a British-run company. Really hard. Try to find a utility supplier that is British-owned. Try to find a train operator that isn't a foreign state subsidiary. Try to buy food from a supermarket that isn't owned by private equity. Sainsbury's and Tesco are the last ones standing in the supermarket sector. But for how long? The wolves are circling. The private equity firms are running the numbers on Sainsbury's right now. They are looking at the property portfolio. They are licking their lips at the thought of a sale and leaseback deal. If we lose them, the entire food supply chain goes. This matters. It matters for food security. It matters for national resilience. In a crisis, you need to control your own supply chains. We saw that in the pandemic. We saw that in the energy crisis. When the chips are down, national borders matter. You cannot regulate a company that doesn't care about your regulator. You cannot fine a company that is effectively bankrupt. You cannot shame a private equity firm that operates in the shadows of the Cayman Islands. We have lost control. We are passengers in our own country, and the driver is a private equity algorithm based in an offshore tax haven. So here is the question I want you to answer. It is a simple one, but it matters. When you look at your bills for water and energy and transport, do you feel like a valued customer? Or do you feel like a cash cow being milked by a distant owner who doesn't care about the service you get? And do you think it is time for the government to step in and take back control of our critical assets? Or has that ship sailed? Is it too expensive to buy it all back now? Let me know in the comments below. I really want to read your take on this. I read every comment, and if you found this report useful, please subscribe. We are going to keep digging. We are going to keep following the money. Because someone has to tell Sid the truth. Thanks for watching.